I have watched people make the same mistake in every cycle. They look at the front number and ignore the machine behind it. In housing, the front number is the price on the listing. The machine is the monthly payment, the interest rate, the tax bill, the insurance, the buyer pool, the credit markets funding the buyers, and now, in this cycle, the institutions that may be forced to become sellers all at once. That is where the trap is. If you had asked the average family in 2020 whether the same house could feel twice as expensive without doubling in price, many of them would have said no. But that is exactly what has happened. A median home around $328,000 with a roughly 3% mortgage could produce a payment near $1,100 a month. Move that same basic house into 2026 at roughly $420,000 and a mortgage closer to 6.5%. And now the payment is around $2,200 a month. The house did not double, the burden did. That distinction matters more than most people realize. People do not buy homes with abstract prices. They buy homes with monthly cash flow. They buy homes with confidence. They buy homes with wages that must survive groceries, gasoline, insurance, childcare, and all the other obligations that never stop. So when I hear someone say housing is only up about 20-something% from where it used to be, I know they are looking at the headline and missing the operating system. If your payment has doubled while your income has risen only modestly, you are not living in the same market anymore. You are standing in a different country with the same street names. That is the first thing I want you to understand. The housing market is not a price market first. It is a pressure market first. Once you understand that, what is happening becomes much easier to see. A lot of people still think the story is simple. They believe the market became unaffordable because rates went up, and that if rates fall, the whole thing fixes itself. That is too soft, too incomplete, and too comforting. In the real world, one broken pipe rarely stays one broken pipe. Pressure travels. It looks for the weakest valve. It looks for the party that cannot hold on. And in this cycle, there are several weak valves sitting inside the system at the same time. The first is the American buyer from 2020 to 2026. Incomes did rise, but they did not rise anywhere close to the speed needed to absorb a home whose carrying cost effectively doubled. Not when property taxes rise with assessed values. Not when insurance costs rise with replacement values and regional risk. Not when everyday life becomes more expensive at the same time. A family can survive a home that is a little expensive. It struggles with a home that crowds out every other decision. The math turns the dream into a treadmill. You make more and feel poorer. That is what house poor really means. It is not a slogan. It is a cash flow condition. The second weak valve is the interest rate fantasy. I have seen investors talk themselves into easy rescues for decades. In 2026, one of the favorite fantasies has been that lower rates would ride in and repair affordability. Lower mortgage rates would lower payments, revive demand, and keep the whole housing structure standing on the same elevated price base. It is a lovely theory. It is also dependent on a world that may not show up on schedule, because rates do not move in a vacuum. They move inside an economy. And an economy does not care about what homeowners want. It responds to incentives, shocks, commodity prices, labor conditions, and inflation pressure. This is where the chain gets serious. If energy prices move sharply higher because conflict drives oil upward, the cost of many things moves with it. Transportation gets more expensive. Food distribution gets more expensive. Travel gets more expensive. Business input costs get more expensive. Inflation, which policymakers were hoping would behave, starts acting like a live wire again. And when inflation becomes a live wire, the central bank does not get to play hero for home buyers. It gets handcuffed. That means the rate relief people were counting on can get delayed, weakened, or even replaced by the opposite. Now you no longer have a market waiting for rescue. You have a market waiting under pressure. That alone would be enough to create strain. But the story does not stop there, because the most interesting part of this cycle is not only the household side, it is the institutional side. Most families think they are competing against the neighbor, the young couple, the retiree moving south, or the small landlord down the road. In recent years, that has not been the whole picture. They have also been competing against large pools of capital. Institutional buyers came into single family housing in a meaningful way because housing could be turned into a yield product. Rent streams could be packaged, financed, modeled, and scaled. Homes stopped being only homes. They became line items inside giant financial machines that changed the bidding environment when you add a buyer with cheaper access to capital professional systems and an appetite measured in neighborhoods rather than zip codes. You distort the ordinary family market. You do not need institutions to own all the houses to change price behavior. You only need them to matter at the margin. A market gets set at the margin. One aggressive bidder can reset the tone for everyone else. That is one of the reasons supply felt tight and prices felt stubborn. But the same force that helps a market on the way up can hurt it on the way down. Large institutions are not emotional sellers. They are system sellers. That sounds safer. In some ways, it is more dangerous. A family may hold on too long because it is attached to the house. An institution may hold until a spreadsheet says sell. Once the spreadsheet says sell, the sentiment disappears. The home is no longer a kitchen, a backyard, or a school district. It is inventory, it is collateral, it is a line that can be reduced. And that brings us to the third weak valve, private credit. After the financial crisis years ago, the traditional banking system became more regulated. Capital still needed somewhere to go. Borrowers still wanted money. So lending migrated into a world that looked bank, like without being bank, regulated in the same way. Private credit expanded because capital always finds an opening. When the official door gets narrower, money climbs through the window that worked beautifully while borrowing was easy. Rates were lower and asset prices were generous. Then time passed. Rates stayed higher. Borrowers who looked healthy in a cheap money world looked fragile in an expensive money world. Some of the companies that had borrowed heavily started feeling the squeeze. In this transcript, one especially important group shows up: software businesses and other firms pressured by the arrival of AI. That matters because a borrower does not default in theory. It defaults when its revenue assumptions collide with a new reality. If customers can replace a software bill with internal tools or AI-assisted work, then a business model that looked stable can weaken faster than the lender planned for. Now combine that with debt that must be refinanced in a harsher rate environment. You start with higher interest expense. You add weaker business demand. You add capital that expected easy withdrawals and smooth returns. Now you have stress. When stress enters a private credit structure, redemption pressure follows. Investors who were promised attractive yields and convenient access begin to remember that liquidity is a luxury, not a law. If enough of them want money back while the underlying loans are under strain, managers have to do something unpleasant. Sometimes they gate, sometimes they stall, sometimes they sell what they can sell. That is the key phrase, they sell what they can sell. And one of the things many big institutions can sell is real estate. This is where the average observer still misses the story. They think housing is its own island and Wall Street trouble is something happening in a different room. That is not how modern finance works. The rooms share hallways. Pressure in one room moves into the next room through financing needs, redemption demands, and collateral management. If a fund, a sponsor, or a giant asset manager faces losses or illiquidity in private credit, it may not be able to fix that pain with wishes. It may have to raise cash. And if it raises cash by selling housing-related assets, single-family supply can rise even while households remain priced out. That is how you get a flip, not because every homeowner panics, not because foreclosures suddenly flood the country, but because a market that was held up by scarce supply can get a new source of supply from owners who do not think like homeowners at all. I want to name the mechanisms for you clearly, because if you cannot name a mechanism, you usually cannot act intelligently around it. The first mechanism is what I call payment shock gravity. That is the force that turns a moderate move in price plus a major move in rates into a brutal move in monthly burden. It keeps ordinary buyers pinned down. It weakens demand without needing a recession headline. It makes affordability collapse faster than wage growth can respond. The second mechanism is rate relief mirage. That is the habit of assuming the central bank will rescue housing, simply because housing feels important. It ignores the fact that policymakers answer to inflation conditions. First, if energy and inflation remain sticky, the rescue gets delayed. The market sits under strain longer than people expected. The third mechanism is institutional reversal. A large buyer base that once absorbed supply can become a seller base that adds supply. In strong markets, institutions compress inventory. In stressed markets, they can release inventory. The same hand that supported prices can become the hand that pressures them. The fourth mechanism is collateral contagion. Trouble in one financing silo can force sales in another silo. Private credit pain does not stay politely inside private credit. If the owner of those loans also owns real estate, raises capital across platforms, and must preserve liquidity or calm investors. This is where modern markets punish people who think in categories instead of systems. The fifth mechanism is phantom equity. I have warned about this for years in different forms. Homeowners begin treating estimated home value like spendable wealth. They borrow against it, they refinance against it, they buy consumption with it. They forget that equity is not cash until a transaction turns it into cash. If home prices fall even modestly after a period of leverage and equity extraction, people who believed they were safe can discover they were standing on a number that existed only as long as the last comparable sale held up. That is why I never want you to think like a gambler when you own a home. A family home is shelter first, memory second, speculation a distant third. If you bought it to live in and can comfortably afford it, you are in a different position from somebody who bought it as a leveraged fantasy machine. But if you have been living off rising appraisals, pulling cash out, and assuming the staircase only goes one way, you are not managing a home. You are managing a balance sheet illusion. The hardest lesson in markets is that invisible wealth disappears faster than visible debt. Now let me push this one level deeper, because this is where the identity flip has to happen. Most people move through housing as emotional shoppers. They ask, can I picture myself here? A smarter minority moves through housing as cash flow analyzers. They ask, can I survive this payment? But the investor I want you to become asks a different question. He asks, where is the pressure in the system? Who is likely to become a forced seller? And what kind of asset can I buy only when the pressure finally shows up in price? That is the flip. You stop being a spectator of house prices and become a student of forced supply. You stop thinking like a borrower first and start thinking like a balance sheet buyer. You stop asking whether this market feels unfair and start asking where the machine is weakest. That is how wealth is built in ugly periods, not by being cheerful, not by pretending every dip is automatically a bargain, by understanding who is cornered and who is liquid. When I was younger, one of the most valuable things I learned was that good assets do not usually become cheap because the asset itself changed overnight. They become cheap because the owner cannot keep holding it on the same terms. That lesson shows up in stocks, businesses, bonds, and real estate. Markets do not hand out discounts as gifts. They hand them out as consequences. This housing cycle may hand out consequences. If institutional investors truly reduce purchases, or if some of them move from net buyers to net sellers, the tone of the market changes. If political pressure also keeps building against institutional ownership of single-family homes, the narrative support weakens further. If private credit stress deepens and rate pressure stays elevated, the supply side can change in ways ordinary home shoppers have not seen for years. Suddenly, the family that felt powerless at the open house is no longer bidding against an empire. Suddenly, the seller has to explain himself. Suddenly, the concession comes back. Suddenly, the price cut is not a rumor. It is a strategy that would not mean every market collapses. I do not want you to hear a national forecast where only a local map will do. Housing is always regional, often neighborhood-specific, and sometimes street-specific. Some places are far more exposed to institutional ownership than others. Some markets have stronger employment support, better migration, tighter land constraints, or more resilient buyer bases. Some markets will stay firm much longer than the loudest headlines expect. Others can weaken with surprising speed. That is why broad emotion is so expensive. You need local reality. You need to know whether your market is dominated by ordinary owners, builders, institutional landlords, overleveraged short-term investors, or some unstable mixture of all four. You need to know whether rent supports the price. You need to know whether inventory is genuinely rising or merely being talked about. You need to know whether sellers are cutting because they are strategic or because they are desperate. Those are different markets wearing the same label. But the large lesson remains the same. Housing is entering a regime where convenience may lose to pressure. That phrase matters for years. Convenience ruled. Institutions could buy, owners could refinance, buyers could stretch, capital could flow, policymakers could talk softly. The whole system could pretend rising values solved everything. Pressure was hidden by liquidity. When liquidity retreats, truth returns, then carrying cost matters, then debt structure matters, then redemption terms matter, then who needs cash matters, then who can wait matters. And once those questions dominate, markets stop rewarding the most optimistic voice and start rewarding the strongest balance sheet. If you are a homeowner, my advice is simple. Do not build your emotional peace on Zillow estimates. Do not finance lifestyle inflation with borrowed home equity unless you have a brutally clear reason and a conservative repayment plan. Keep your payments survivable, keep your reserves respectable. If your house is affordable and long-term appropriate for your life, do not let every headline shake you. Shelter is not a day trade. But do not confuse a place to live with an inexhaustible ATM either. That mistake has ruined more families than bad wallpaper ever did. If you are a first-time buyer, this is not the moment to worship speed. It is the moment to worship flexibility and patience. In overheated times, buyers are told to chase. In changing times, the advantage shifts to the one who can wait without emotional leakage. Know your payment ceiling, know your down payment, know your reserves, know your local inventory. Know which neighborhoods were inflated by investor appetite and which ones were supported by genuine owner demand. The buyer who knows where institutional pressure is likely to hit has a better chance of buying value instead of buying narrative. If you are a real estate investor, I would tell you something even more direct. Do not enter this market pretending leverage is genius. Leverage is not genius. Leverage is speed. Sometimes speed helps. Sometimes it drives you into a wall faster than an unleveraged man even arrives at the intersection. If opportunities emerge because institutions or distressed owners have to sell, you want dry powder, underwriting discipline, realistic rents, and humility. You do not want optimism decorated as courage. I would rather miss a flashy deal than own a fragile one that requires perfect rates, perfect occupancy, perfect refinance terms, and perfect economic weather just to survive. That is not investing, that is begging. The blueprint in a period like this is not mysterious. First, protect liquidity. Cash is not exciting, but optionality is worth a great deal when markets move from tight supply to selective distress. Second, study where institutional ownership actually matters. Do not generalize, build a map. Some towns are story stocks, some are cash flow assets, some are simply overpriced emotional products waiting for reality. Third, underwrite using bad weather assumptions, not sunny day fantasies. Use higher rates. Use vacancy assumptions that make you uncomfortable. Use repair budgets that admit life exists. If the deal still works, now you are speaking my language. Fourth, separate shelter from speculation. If you buy a house to live in, buy for durability of payment and quality of life. If you buy to invest, buy for yield, margin of safety, and resilience under pressure. Confusing those two categories is how people overpay with conviction. Fifth, treat falling prices as information, not automatic opportunity. A price drop is only attractive if the asset still has durable value, and the seller's pain does not reveal a deeper structural wound you failed to see. Sixth, do not anchor to 2020 psychology. The cheap money world taught people terrible habits. It taught them to worship monthly payment tricks, extrapolate appreciation, and assume central banks existed to rescue every leveraged position that school is closed. And now we arrive at the choice that matters. You can keep looking at housing as if it is still a simple ladder. Work hard, borrow large, trust appreciation, and hope the next buyer bails you out, or you can start looking at housing the way I look at every market that matters. As a pressure system, a system where rising energy costs, sticky inflation, stubborn rates, private credit stress, institutional balance sheets, and local supply all feed into one another until somebody finally has to move first. If you understand that system, you stop chasing appearances, you begin waiting for pressure to reveal value. That is the difference between the family who buys near the top because it is tired and the investor who buys later because he studied the plumbing. One is buying relief, the other is buying mispricing. The next few years may produce both fear and opportunity in housing. They may hurt the reckless, embarrass the overconfident, and reward the liquid. They may remind America that a home price is never just a home price, and that a market propped up by constrained supply can change fast once new supply arrives from owners who must sell for reasons the average family never even sees. If that day comes, and I believe some version of it very well may, I do not want you standing there with borrowed optimism and phantom equity, telling yourself that the old rules will come back because they feel more comfortable. I want you standing there with cash patience and a mind trained to recognize forced selling when it finally enters the room, because the housing market does not ring a bell when the power shifts. It just quietly hands negotiating leverage to the person who prepared before the pressure became visible. And if you miss that shift because you were still admiring yesterday as home values, you will learn the oldest lesson in finance the hard way. The market does not care what your house was worth in a friendly regime. It only cares what someone can and must pay when the pressure changes. That is the test. And the people who pass it are not the ones who loved the story of housing the most. They are the ones who understood the pressure before the price finally admitted it.